I want to tell you something before we dive in today, and I need you to actually hear this part because it sets up everything that comes after. A few years ago, I was sitting at my desk doing what I do every single week, going through earnings transcripts, tracking institutional 13F filings, building revenue models, looking for the convergence of signals that tells you something big is about to happen before the rest of the market figures it out. And during that process, I identified two companies that most people around me either had not heard of or had already written off as overpriced, overhyped, or too complicated to understand. One of them was NVIDIA, one of them was Palantir. I got into both of those positions before they went parabolic. I held through the volatility, through the short seller attacks, through every analyst on financial television explaining why the valuations made no sense, and those two positions fundamentally changed my relationship with money and with investing. I am not telling you that story to impress you. I genuinely do not care about that. I am telling you that story because the methodology I used to find those trades is not magic. It is not insider information. It is not luck. It is a repeatable framework that looks for specific, measurable signals in the data, and that framework is flashing right now on a company that most retail investors either do not know about or do not fully understand yet, a company that already has the institutional validation that NVIDIA and Palantir did not have until years into their runs. A company that just reported 684% year-over-year revenue growth. A company that NVIDIA itself has backed with $2 billion, and that Meta has committed $12 billion to in contracted revenue. This is the kind of situation I have been waiting to talk about for months. And before we go any further, if you are not subscribed to Wealth Lab, do it right now, because this is the caliber of research I put out every single week. And the people who are subscribed are the ones who get to this information before it becomes consensus. Hit the subscribe button, turn on notifications, and let's get into it. I want to take you back to the specific moment I became fully convicted on NVIDIA, because the details of that process matter for understanding why I am so focused on the company I am about to show you. The year was 2022. NVIDIA had just come off a brutal drawdown. The stock had been cut roughly in half from its highs. The narrative on Wall Street was that the gaming cycle had peaked. Crypto demand had collapsed, and the company was facing a severe inventory correction. Every short-term signal pointed down. The stock looked terrible on a surface-level read. But when I went deeper into the numbers, I found something that the headline narrative completely missed. The data center segment was quietly becoming the dominant driver of the business, and the trajectory of that growth was unlike anything I had seen in the semiconductor space in years. Revenue in data center was not just growing, it was accelerating in a way that suggested the underlying demand was structural, not cyclical. It was not tied to the gaming cycle, it was not tied to crypto, it was tied to the build out of AI infrastructure, and that build out was just getting started. The second thing I noticed was the moat. NVIDIA's CUDA software ecosystem had been built over more than a decade. Every major AI research team in the world had built their workflows on top of it. Every AI graduate student learned to code on it. Every enterprise deploying machine learning had standardized on it. That kind of ecosystem lock-in does not get disrupted in a quarter or a year. It takes an alternative that is not just marginally better, but categorically, overwhelmingly better, and even then the switching costs are enormous. The moat was not just the chips. The moat was the entire software and developer ecosystem wrapped around those chips. And the third signal was the institutional accumulation. When you look at the 13F filings from that period, you can see the pattern clearly in retrospect. The largest, most sophisticated investment funds in the world were building positions quietly. Not announcing it, not pumping it on television. Just steadily accumulating shares while retail investors were focused on the short-term inventory noise. Those three signals in combination, accelerating structural revenue growth, an irreplaceable technology moat, and smart institutional money moving in ahead of the crowd, formed the core of my conviction. And I held that conviction through every piece of negative news, every analyst downgrade, every moment where the easy thing would have been to take profits and walk away. Palantir was a different flavor of the same thesis. The public narrative on Palantir in the early years was almost uniformly negative, too dependent on government contracts. Founder-led governance concerns, unprofitable, burning cash, overvalued based on any traditional metric, but when I went through the actual filings and looked at what the business was doing at a structural level, the picture was completely different from the headline narrative. The revenue growth was real and it was accelerating. The net revenue retention was telling you that existing customers were not just staying, they were expanding their usage and spending more every single year. The technology they had built for government intelligence applications was being adapted for enterprise commercial clients, and that transition was opening up a market opportunity that dwarfed the original government business. And critically, the institutional ownership was climbing. Quarter after quarter, the composition of the shareholder base was shifting from retail speculators to serious, long-term institutional holders. That shift in ownership profile is one of the most reliable leading indicators of a stock that is about to get repriced to a significantly higher level. Both of those trades followed the same playbook. Both of them required ignoring the consensus narrative and trusting the data. Both of them rewarded patience and conviction in a way that completely changed my financial trajectory. And both of them are now so well known, so widely owned, so thoroughly analyzed by every major research house on Wall Street, that the kind of asymmetric opportunity they represented in their early days is essentially gone. NVIDIA is a $10 trillion company. Palantir is widely held by retail and institutional investors alike. Those early entry opportunities do not exist anymore in those names. But the framework that identified them still works, and right now that framework is pointing at something new. The company is Nebius Group, ticker symbol NBS on the Nasdaq, and I want to spend real time on this because I think most people who have heard the name still do not fully understand what they are looking at. Nebius is an AI cloud infrastructure company, but that description is too generic to capture what makes this business special. So let me be much more specific. The traditional hyperscale cloud providers, Amazon Web Services, Google Cloud, Microsoft Azure, were architected for a world that existed before the large language model revolution. They are massive, general-purpose platforms that were originally built to serve the broadest possible range of computing needs, from hosting websites to running databases to streaming media. Over time, they added AI capabilities on top of that existing infrastructure. And those AI capabilities work, but they carry the overhead and inefficiency of systems that were never designed specifically for AI workloads in the first place. Nebius took a fundamentally different approach. They built their entire platform from the ground up with one singular purpose: running AI workloads as efficiently, as powerfully, and as cost-effectively as possible. Every architectural decision, every hardware selection, every layer of the software stack, all of it optimized specifically for the demands of training large AI models, running inference at scale, and serving the needs of the companies building the next generation of AI-powered products. When a customer comes to Nebius, they get access to a complete, fully integrated solution. Large-scale GPU clusters, cloud platform services, developer tools, storage systems, networking infrastructure, all of it in one place. All of it designed to work together seamlessly for AI use cases, specifically. No stitching together services from 6 different vendors. No paying for general-purpose compute that is fundamentally inefficient for AI workloads. Just a purpose-built platform that does one thing exceptionally well. This distinction sounds technical, but it has enormous commercial implications. As AI workloads have grown more complex, more compute, intensive, and more economically significant, the gap in efficiency between purpose-built AI infrastructure and general-purpose infrastructure has become increasingly expensive for customers. Enterprises that are serious about AI at scale are starting to look very hard at their infrastructure choices, and the math increasingly favors platforms built specifically for AI. Nebius is positioned to capture exactly that demand shift. Now, let me go through the 3 signals I described earlier and show you exactly how they apply to Nebius today, because this is where the thesis gets genuinely compelling. Signal number 1 is accelerating revenue growth that is breaking every model analyst built for this company. In the first quarter of 2026, Nebius reported revenue of $399 million. Wall Street's consensus estimate was $388 million. The company beat estimates and reported 684% year-over-year revenue growth in a single quarter. Read that number again. 684%. In one quarter, that is not noise. That is not a one-time contract recognition. That is the manifestation of a demand environment that is structurally stronger than anyone outside the company fully anticipated. The forward guidance is equally staggering. Nebius is guiding for full year 2026 revenue of $3 to $3.4 billion. Their annualized recurring revenue target by the end of 2026 is $7 to $9 billion. They entered 2026 with a run rate of $1.25 billion. The trajectory from $1.25 billion to $9 billion in 12 months is not a projection built on hope. It is a trajectory built on contracts that are already signed, hardware that is already being deployed, and customer relationships that are already generating revenue. This is not a company that is guiding to hockey, stick growth based on business they have not yet won. This is a company that can see the revenue coming because the deals are already in place. And the Wall Street response to this growth profile has been unambiguous. Bank of America raised their price target to $205 ahead of earnings. The analyst consensus rating is strong buy across 12 analysts who cover the name. The maximum price target on the street sits at $291. The average price target across all analysts is approximately $168. The stock closed on May 13th at $207, which means it has already run past many of the existing targets, which will force analysts to revise higher as the execution continues to validate the thesis. When a stock runs past analyst targets, and the underlying fundamentals are still accelerating, that is a signal that the market is in the process of discovering something that the initial models did not fully capture. Signal number 2 is the technology moat. And this is where Nebius is fundamentally different from most AI infrastructure companies that have come before it. The moat here is not just about building a good product, the moat is about access. In March 2026, NVIDIA announced a $2 billion strategic investment in Nebius for an 8.3% stake in the company. But the money, as significant as $2 billion, is almost the secondary part of the deal. The primary part is what comes with it. Through this partnership, Nebius receives priority early access to NVIDIA's most advanced hardware, including next-generation Rubin platform accelerators, Vera CPUs, and Bluefield storage systems. These are chips and systems that no other cloud provider outside of NVIDIA's most trusted inner circle can access before they are broadly available to the market. Think about what that means competitively. In the AI infrastructure business, the company that has the most powerful chips first can offer capabilities that nobody else can match. They can run larger models. They can process more requests simultaneously. They can deliver better price performance to their customers, and they can attract the highest value AI workloads because they are the only ones who can handle them. Nebius has that hardware access advantage locked in contractually with the company that makes the chips that power essentially all serious AI development happening on Earth right now. That is a moat that cannot be quickly replicated regardless of how much capital a competitor deploys. You cannot buy your way to the front of NVIDIA's priority hardware queue. You have to be chosen. Nebius was chosen. Beyond the hardware access, the two companies are engaged in genuine co-development work. They are jointly refining AI factory deployment processes, optimizing production software, and building the operational playbook for what Jensen Huang calls the agentic era of AI infrastructure. This is not a vendor relationship. This is a technical partnership at the deepest level, and it creates a compounding advantage over time. Every quarter that this partnership continues, Nebius builds deeper operational expertise with NVIDIA's most advanced systems. And that expertise widens the gap between Nebius and competitors who are working with the same hardware on a non-priority basis. Signal number 3 is institutional commitment. And this is where the Nebius story starts to look genuinely different from where NVIDIA and Palantir were when I first started building positions in them. The NVIDIA investment we have already covered, $2 billion, 8.3% stake. Jensen Huang personally describing the company as the infrastructure for the agentic era. That is a strong signal from the most important company in AI. But the Meta and Microsoft contracts tell an even more important story about the commercial validation of what Nebius is building. Meta Platforms signed a deal to purchase $12 billion in AI computing capacity from Nebius through 2027, with an option to expand by an additional $15 billion over 5 years. Meta has some of the most sophisticated AI infrastructure capabilities in the world. They have built their own custom AI chips. They have massive data centers. They have an entire infrastructure engineering organization whose job is to make AI compute as efficient and cost-effective as possible. And despite all of that internal capability, Meta looked at what Nebius was offering and decided that purchasing from Nebius was the right economic and technical decision. That is not a small contract they signed to test the waters. That is a fundamental infrastructure commitment from one of the largest AI operators on Earth. Microsoft has a $17 billion contract in place with Nebius. Microsoft operates Azure, one of the largest cloud platforms in the world. Microsoft has invested tens of billions of dollars in OpenAI and in building its own AI infrastructure. And Microsoft is still choosing to purchase AI computing capacity from Nebius, because there are workloads and use cases where Nebius's purpose-built infrastructure delivers better results than what Microsoft can produce internally. That speaks to something real about the differentiation of what Nebius has built. When the three companies most central to the AI revolution, NVIDIA, which makes the chips, Meta, which runs some of the largest AI models in the world, and Microsoft, which is the largest enterprise AI platform operator, are all financially committed to Nebius at a combined level of nearly $30 billion in investment and contracted revenue. That is not speculation. That is as close to a market consensus as you can get at this stage of a company's development without it being a mature, fully priced business. And Nebius is still not a fully priced business. Not even close. There is also a groundbreaking infrastructure development that most investors have not fully absorbed into their thesis yet. Nebius has broken ground on a 1.2 gigawatt AI factory campus on 400 acres near Independence, Missouri. The land is acquired. The power agreements are signed. Construction is actively underway. Power delivery is scheduled for the second half of 2026. When that facility comes online, it will make Nebius one of the largest AI infrastructure operators in the United States by raw compute capacity. And this is only the beginning. Through their NVIDIA partnership, Nebius is targeting total deployment of more than 5 gigawatts of NVIDIA systems by 2030. 5 gigawatts of AI compute capacity would make them one of the most significant infrastructure operators in the history of the technology industry. Now, let's talk about how to position around this, because the most important thing about identifying the right company is making sure you do not ruin the trade by managing the position incorrectly. The first thing I need you to understand is the volatility profile. Nebius has a beta of 3.13. For anyone not familiar with that term, beta measures how much a stock moves relative to the broader market. A beta of 1 means it moves in line with the market. A beta of 3.13 means that if the S&P 500 drops 2% in a day, Nebius might drop 6%. If the market rips 1.5%, Nebius might be up 4 or 5%. This is not a stock you buy and then stop paying attention to. This is a stock that will test your conviction regularly and aggressively. It will have days and probably weeks where it drops in ways that make you question everything you believe about the thesis. That is the price of admission for the kind of upside this growth profile represents. If you cannot stomach that kind of short-term volatility, you need to size your position accordingly or not participate at all. The approach I use for high conviction, high volatility situations like this is systematic position building through dollar cost averaging. I do not try to pick the perfect entry point, because nobody can do that consistently, and the attempt to do so usually leads to either missing the opportunity entirely or making emotionally driven decisions at exactly the wrong moments. Instead, I determine my total target position size first. I decide what percentage of my overall portfolio this idea deserves, and I come to that number by thinking carefully about both the upside potential and the realistic downside scenario. For a name with this volatility profile and this valuation, I want to make sure that even a 40 or 50% correction in the stock does not cause me to make irrational decisions. If the position is sized appropriately, a 40% pullback is painful but survivable. If it is sized irresponsibly, a 40% pullback turns into panic, selling at the worst possible time. Once I have my target size, I build to it across multiple tranches, an initial entry when the thesis is confirmed and the technical setup looks reasonable. A second tranche on a meaningful pullback, because with a beta this high, pullbacks will come and they will feel terrifying in the moment, and that is exactly when you want to add if the fundamental thesis is still intact. And a third tranche reserved for a major confirmation catalyst, either a blowout earnings report, a new major contract announcement, or a development in the NVIDIA partnership that the market has not yet fully priced in. This approach removes the pressure of timing and forces me to stay disciplined around the thing that actually matters most, which is not when I buy but how much I buy relative to my total risk tolerance. Now I need to walk you through the risks, and I need you to actually listen to this part rather than tuning out, because you are excited about the upside. The risks on this name are real and they are significant. The valuation is the most immediate risk. Nebius trades at a price-to-earnings ratio of approximately 364 times. That is a valuation that is pricing in years of perfect execution. It leaves essentially no room for error. A single quarter where revenue misses meaningfully, a single major contract that does not renew, a single delay in the Missouri infrastructure build. Any of those things could result in a correction of 20 to 40% very quickly. High growth, high valuation stocks are brutally unforgiving of execution shortfalls, and the higher the valuation multiple, the more violent the reaction to any negative surprise. That is not a reason to avoid the name. It is a reason to size your position intelligently and to be psychologically prepared for sharp short-term drawdowns. The competitive pressure is also real and intensifying. AWS, Google Cloud, and Microsoft Azure are all investing aggressively in AI, optimized infrastructure, and they have balance sheets and enterprise relationships that dwarf anything Nebius currently has. Huawei, CoreWeave, and a growing list of other neo-cloud competitors are all targeting the same market. The advantage Nebius holds today is real, but it requires continuous reinforcement through execution, innovation, and the delivery of what the NVIDIA partnership has promised. If the technical differentiation narrows over time, the premium valuation will compress. That is a risk that every investor in this name needs to hold in mind. The cash burn reality is also something to understand clearly. Building out gigawatts of AI compute infrastructure requires staggering capital expenditure. Nebius is planning capital expenditure of up to $20 billion to expand its infrastructure. That spending happens before the revenue from the newly built capacity fully materializes. In favorable financing conditions and with strong revenue execution, this is manageable. In a risk-off environment, or if revenue growth disappoints, the balance sheet could come under pressure in ways that are difficult to predict in advance. Here's the bottom line that I want you to carry out of this video. I spent years developing a framework for identifying the kind of structural growth opportunities that most retail investors either miss or discover too late. That framework identified NVIDIA before it became the most valuable chip company in history. It identified Palantir before it went from a Wall Street punchline to a portfolio staple for serious growth investors. And right now, every element of that framework is pointing at Nebius Group with the same intensity I have rarely seen outside of those two situations. The revenue growth is real, contracted, and accelerating in ways the initial models did not anticipate. The technology moat is structurally deeper than most of Nebius's competitors can match, because the NVIDIA hardware access advantage is not something you can replicate with capital alone. The institutional commitment from NVIDIA, Meta, and Microsoft represents nearly $30 billion in investment and contracted revenue from the three most important organizations in the AI ecosystem. And the infrastructure build-out underway in Missouri is laying the physical foundation for a capacity base that will make Nebius one of the most significant AI infrastructure operators in the world by the end of this decade. This is not a rumor. This is not a tip from someone at a conference. This is a technology transformation that is playing out in real time, in plain sight, backed by the most credible institutional validation that exists in the AI space, with a revenue trajectory that is already proving the thesis correct every single quarter. Before I let you go, I need to read the disclaimer and I need you to take it seriously. Nothing in this video constitutes financial advice. I am not a registered investment advisor. Everything shared here is for informational and educational purposes only. Investing in individual stocks involves substantial risk, including the risk of losing your entire investment. The fact that I have had success with previous investment ideas does not guarantee similar outcomes in the future. Past performance is not indicative of future results. The analyst price targets and institutional data referenced in this video represent third-party research and analysis and are not guarantees of future stock performance. Always conduct thorough independent due diligence and consult with a qualified licensed financial professional before making any investment decision. Position sizing and risk management are your personal responsibility. Now here is what I want from you. You have heard the complete thesis, you have seen the numbers, you understand the framework. Bank of America has a price target of $205. The most bullish analyst on the street has a target of $291. The stock is currently trading around $207 after a 684% revenue beat and a 550% run over the past 12 months. Where do you think NBS is trading 12 months from today? Drop your price target in the comments right now with one sentence explaining your reasoning. I am going to go through every single response. I am going to pin the most thoughtful, most well-reasoned price prediction at the top of the comments. Not the highest number, not the lowest, the one that shows real analytical thinking. Let's see who has been doing the work. Put your number down.